What I want to discuss in this slide is a home equity loan and how a home equity loan is very similar to a loan that you get with a cash value life insurance policy. So for example, you own a $500,000 home, you take a $150,000 loan using the home as collateral, okay? And let's just say for this example, and I know this isn't how it works, or these numbers isn't how it's going to be, but let's just say hypothetically your home appreciates by 5% annually. And 5% appreciation on a $500,000 home would be $25,000 in appreciation year one, okay? So your new value of that home after year one would be $525,000. Even while you still have that loan out of $150,000. So even though I took a loan, a home equity loan of $150,000 and my property appreciated, it's my property appreciated on the fair market value of it, not the fair market value less the loan amount that I have left. So it wasn't 5% appreciation on $350,000, it was 5% appreciation on the fair market value of the property. So that's very similar to how a cash value, specifically a whole life insurance policy, works, okay? And then I have here, it's important, like kind of what I just touched on, the appreciation's happening on the full market value, not just your remaining equity. So you're not getting that 5% appreciation on $350,000, it's on the full $500,000 of the property. And in this case here, you access $150,000, you took a loan out, you use that for whatever, buying another property or investing somewhere else, and you gain $25,000 on the appreciation of the property at the same time. So very similar concept to borrowing against a policy. And then here, whole life policies work the same way like I touched on. So just to wrap up and recap here, borrowing against a piece of property and borrowing against a whole life policy is very, very similar.